Hi, and welcome to our end of December and end of year update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of the book The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month is a end of year review of our systems, including the 20-month moving average system, the monthly rotation investment system, or the MRI. I'll look at the Ray Dalio All Seasons portfolio that only requires one rebalance every year, touch base on the trailing stop system, and a closer look at Sector Surfer. So to review our systems, the first one is the 20-month simple moving average system. It's a fairly straightforward system. If the S&P 500 index fund is above the easily calculated 20-month moving average, it's relatively safe to stay invested in the index fund, otherwise get out. So here's what's going on this month. The blue line is our S&P 500 index fund, the VFINX. That's a ticker symbol that I use for this Vanguard S&P 500 index fund. It's the fund that has the most data for me to analyze. And the red line is the 20-month moving average. And so for this month, the VFINX ended at 206.57 here, and the moving average is at 189.03. So if you give a rough calculation of 206.57 over 189.03, you get a 9.3% cushion. That means we have around a month for the stock to stay 9.3% above this, crosses below this line by the end of next month, then consider getting out. But right now, the system is saying it's relatively safe to be in stocks. So here's the cumulative effect of rotating between stocks and bonds. If you take a look at the blue line, that's the dividend-corrected S&P 500 Index Mutual Fund. If you look, whenever this fund is below the 20-month moving average, we get out of stock and we invest in bond fund, and when the stock goes above the 20-month moving average, we go back into stock. If it goes below the line, then we go back to bonds. When it goes above the line, we go back to stock. Now, if you're wondering why, if we didn't even cross into bonds yet in year 2000, why is this black composite line lower than this blue line? That's because, remember, all the data that I'm illustrating here are corrected for fees, just in case you want someone else to do this for you. I figure if I give you the worst case scenario and you do this yourself, you'll probably do better. So here is the data presented in a different form. So we have a column representing the annual gains of the S&P 500 index fund versus the system if we switch between stocks and bonds using the 20-month moving average, 1987 all the way to 2016, for a total annualized gain of 9.43% for if you bought, held, and reinvested within the S&P 500 index fund, or 10.63% if you follow the 20-month moving average system. Now note, there's only a roughly 1.2% difference per year between the two systems, and yet one system ends up with 40% more than the other. That's the effect of compound interest over 29 years. So if you take a look, if you just bought, held, and reinvested, these red circles highlight the times when we lost money in the markets, versus these red circles showing when the system lost money. Now, the losses aren't as large as stocks themselves. However, if you take a look at the last 2 years, we've had those whipsaws which dragged on our returns. Similarly, back in 2011, we had a whipsaw that dragged on returns. Whipsaw is, when we go back to this system, when 1 month it goes below the line, next month it goes above the line. So 1 month we were forced to sell, next month we were forced to buy. In 2015, 2016, we had 2 such whipsaws. They're rare to happen, and certainly more rare to happen so close in proximity, but they can happen with this system. So observations for this year. The 20-month moving average indicator can be a double-edged sword. Although it can help mitigate larger multi-month market losses, as I showed you before with the whipsaws can happen. And difference of only 1.4% can result in huge differences over 29 years. So next system is a monthly rotation investment system, abbreviated MRI. The rules for this: every month rank 3 different funds: the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund, and then every month sell the bottom 25% of your total portfolio and use that to buy the top fund. So here's what we did this month. You take a look last month prices, this month's prices. S&P 500 Index gained 1.35%. The emerging markets lost 0.6%, and the inverse S&P 500 Index lost almost 2%. And here's a graphical representation of how these various funds did over the last month. So we have a winner, the S&P 500 Index Fund, and we have a clear loser, the Inverse Fund. So last month we were roughly 50% in the Emerging Markets Fund, 25% in the Index Fund, and 25% in the Inverse Fund. This month we're supposed to sell the worst fund, which is the Inverse Fund, and buy the top fund, which is the S&P 500 Index Fund. So if we do that, we end up with roughly 50% emerging markets and 50% index fund. And remember, last month we had a choice of, since the index fund and inverse fund cancel each other out, we were essentially half-half emerging markets and cash. Now we're half-half emerging markets and index fund. So here are the MRI results to date. Since 1994, obviously here's the performance from last year, and this year we tend to go up a little bit. However, the gains in the US stock market itself was greater, and the emerging markets was greater still. So how do we do? Again, here's a head-to-head comparison between the S&P 500 Index Fund and the MRI system. Year-by-year comparison, finally an annualized return of 9.29% if you bought, held, and reinvested the stock fund versus 10.8% annualized return by diligently following the MRI system. So again, just a difference of 1.5% difference gives a 37% difference in portfolio over the last 21 years. Again, the red highlights the down years, and yes, we lagged the S&P 500 index for the last 2 years. That's just the nature of this particular form of sector rotation. So observations for this year: even though for much of this year the emerging markets tended to dominate because of the mini whipsaws of the monthly cyclical price changes that we've experienced, there was a drag. And US stock markets tended to dominate after the elections, so it looks like this system is appearing to be catching this trend and rotating into the trend. So can we combine and improve these systems? Now, you've heard of me talking about this every single month. Don't combine systems, don't mix rules, unless, of course, you've tested what happens if you combine. And in this case, I've introduced Sector Surfer to you before. Sector Surfer has two components. There's a sector rotation system built in, and there's something called Storm Guard Armor. Storm Guard Armor is a way to tell whether or not stocks are in general relatively safe or relatively risky at any one time. So, for instance, here's the Storm Guard Armor way of flipping between a single stock index fund versus a bond fund. In this particular example, Storm Guard Armor trades roughly 1.7 times per year, and by doing so has severely mitigated these big bear markets and impressively smoothed out this yellow growth curve, giving us roughly 16% annualized return for the last 28 years. Pretty impressive. So how can we combine and improve? Well, if you think about the 20-month moving average or the Storm Guard Armor, they're indicators. And you can think of them as being a fulcrum of this balance, trying to gauge whether or not the stock market is relatively safe or dangerous. When the markets are relatively safe, it's okay to go into stocks, or if you're sector rotating, rotate among stock funds to see which fund happens to have the strongest dominant trend at the time. In the case of the 20-month moving average, we use the VFI Index as a sole bull market fund. Now, when the indicator indicates that the stock market is relatively dangerous, then we can get out stock funds and into something safer, such as cash or bonds. Again, with the 20-month moving average, we were using the long-term Treasury bond fund. So how does Sector Surfer Storm Guard Armor compare to our 20-month moving average? This blue line is the S&P 500 index. This red line is the long-term government Treasury bond fund. And this green line is what our 20-month moving average system did in indicating when to flip between stocks and bond funds. This purple line is how the portfolio would have performed in the past if we used the Storm Guard Armor criteria. And in fact, the difference is so striking, instead of using a linear graph, here is a logarithmic graph, better showing you relative performances of these two benchmarks and these two particular portfolios. Now, if you notice, after elections, stocks dipped a little bit but then took off. Bonds, however, kept on decreasing before the elections and after the elections. That's why for this year, the Storm Guard Armor is losing money. So here are the data, side to side, head to head, comparing the S&P 500 index fund, compared 20-month moving average system versus Storm Guard Armor. And what's remarkable about Storm Guard Armor is that there hasn't been a single losing year over the last 27 years of backtesting, except for the last 2 years. And the last year was only because I'm correcting, again, for possible fees that you may pay if you wanted someone else to do this for you. And then this year, we had this unusual occurrence where both stocks and bonds were going down right before the election. And while Storm Guard Armor correctly identified this particular setup as being dangerous for stocks, the alternatives of stocks do not do very well either. However, if you take a look at annualized returns, again, just a difference of 1.5% annualized over 27 years makes a huge difference, even more so if you have almost 4% difference. So can we improve on the rotation model? So remember, we had the indicator model and now the rotation model. What do we mean by rotation? Well, if we were to take the MRI funds and just rotate among which fund would be dominant at any one time, and we do not use storm guard armor. The white line is the S&P 500 index, the green line is the emerging markets, and this purple line is the inverse fund. And what would happen is, by trading maybe once every other year, Sector Server identifies which fund has a dominant trend and then automatically rotates into that one fund until another trend dominates. In this way, we smooth out our graph and we can get roughly 15% per year annualized over the last 23 years. So let's compare head-to-head MRI versus Sector Server rotation. So the MRI, remember, every month we rank the 3, sell the bottom 25% of the portfolio, buy the top fund. The Sector Server rotation is an all-or-nothing system. It detects the top trend and rotates into that trend all at once, and does not get out of it until another trend dominates. So for reference, again, you have the blue line, which is S&P 500 index, the red line, which is the emerging markets, and the green line, which is the inverse fund. Again, because the Sector Server rotation model outperforms the benchmarks so much more, it will be easier to detect the differences using, instead of a linear axis, we'll use a log axis. Here it is. So again, the black is the Sector Server rotation, the purple is the MRI rotation as described in my book. It pains me to say it, as an author, my book is obsolete compared to what Sector Server can do. However, this is a good problem to have. There is progress. If I had systems like this when I was just starting out in 1995, I probably would have retired even earlier, but that's another story. So again, head-to-head comparison between the S&P 500 index, if we were to buy, hold, and reinvest, versus the traditional MRI rotation model, versus a Sector Server rotation model. And yes, if you take a look at the times when the MRI actually lost, for instance in 2000 lost 11%, which is more than S&P 500 index, and lost 13% in 2015, we described last year's video. Sector Server lost even more in 2000, lost almost 24%. However, all the losses were less than 2% in 2009 and 2011 respectively, giving rise to an annualized return of 15.7% compared to 9 or 11% with the S&P 500 index or with the MRI model. So can we improve on a pie chart? That's the crux of what sector rotation is trying to solve. Traditionally, money managers would say, well, we should diversify into a certain percentage stocks, certain percentage real estate, certain percentage international stocks, certain percentage inflation-protected securities such as TIPS, certain percentage into long-term treasuries, and certain percentage of emerging markets. Theory goes, if any one sector fails, it won't crash our entire portfolio. And that's what makes diversification safer. Well, let's examine this concept for a moment. And in fact, this pie chart isn't any old pie chart. It's in fact the Swenson Pie Chart that Tony Robbins described in his book, Money Master the Game, page 329. Swenson, if you don't know, is Yale University's endowment investor. He's legendary among money managers. He's averaged 14% per year for 20 years and advocates this particular portfolio for his own family. However, if we were to examine this particular portfolio using Vanguard funds, you would see in this graph the white line is the S&P 500 index fund for reference. The yellow line is what would have happened if we bought, held, and rebalanced periodically. And yes, you can see that it's true that we will never do as badly or worse than the worst funds. However, it's also true we'll never do as well or better than the best funds. We do average by definition, and average here is 8.91% over the last 20 years. And here you see average returns ranging from 4.0 to 11.2% annualized over the last 20 years. What if we merely sector surfer rotate? In other words, take those 6 mutual funds and just detected whichever fund had a dominant trend at any one time, and we traded roughly 5 times per year. Again, here are all the individual components, but now our yellow line has shifted up. In fact, for the last 20 years, this yellow line annualized averaged 13.5%. Although if you take a look, the last couple of years has been pretty flat. This is sector rotation. And if you notice, we still have not turned on Storm Guard armor. But what if we were to put only the stock funds here, and then put only the bond funds with Storm Guard armor whenever Storm Guard armor says it's relatively dangerous to be in stocks? Well, here we are. We took the 4 stock funds and then the 2 bond funds, and whenever Storm Guard armor indicates that it's relatively dangerous to be in stocks, we switch to one of the bond funds, and then we let Sector Surfer determine which bond fund is dominant at any one time. By doing so, we can now boost our performance to 20% per year for the last 20 years. So again, we're rotating among these funds when it's relatively safe for stocks, like so. And when it's dangerous for stocks, we use one of these bond funds. So, as a recap, SectorSurfer.com, there are 2 main tools. There is a Storm Guard armor, which is similar to a 20-month moving average system, only more robust, but trades more often. So the downside is, if you use Storm Guard armor, gains will likely be short-term capital gains. And then you have the second tool, which is a sector rotation tool, which is like the MRI, only it's more robust and trades less often and can handle up to 12 funds. So in this particular case, we can combine both sector rotation and Storm Guard armor to make an even more robust system. Again, no system is perfect. There are nuances to portfolio construction. Be sure to at least backtest any strategy that you put together with Sector Surfer before considering using them live. And remember, if you're using Storm Guard armor, don't use both stock and bond funds in the when markets are relatively safe column. And if a Sector Surfer strategy is set up properly, you will get a signal through an email or a text. However, for instance, for me, I log on periodically just to make sure I don't have any trade signals pending. And for those of you who are already using Sector Surfer, you probably noticed that this past month, Sector Surfer strategy has indicated that it's relatively safe to go back into stocks. So if you haven't checked yet, log in and check. So the next system is the Ray Dalio portfolio, or the all-season portfolio. It's a pie chart which just requires rebalancing once a year. So the Ray Dalio pie chart, or all-seasons portfolio, was described in Tony Robbins' Money Master the Game. I bring this up just because I know many people have read the book or follow Tony Robbins. The Ray Dalio All Seasons portfolio is constructed using a completely different paradigm than what most money managers use. Most money managers construct a pie chart using relative non-correlated volatile funds to mitigate the volatility measure for risk. For the Ray Dalio All Seasons portfolio, his theory is that based on just 2 economic indicators, whether or not the economy is growing or falling, if inflation is rising or falling, certain asset classes behave differently in different combinations of these two factors. And by using these two factors to relatively weight each asset class, he comes up with this particular portfolio. You can look it up in Tony's book, or here it is. And if we were to test this, here's how their portfolio did if I used the VFI index for stocks, the VFITX for the relative intermediate term bonds, the VUSTX for the long-term treasury bonds, GLD for gold, and the DJP for the commodities index. And here you have a weighted return. In other words, this is a pie chart return with very small losses when losses occur. The most recent loss was last year, 2.9%. This year, we're up 4.6% with an annualized gain of 7.7% compared to if you were to buy, hold, and reinvest stock, 8.9%. Remember, even though it looks like the Ray Dalio All Seasons portfolio is lagging stock-only fund, it is much less volatile. So here's a graph showing the various components plotted with this blue line, the S&P 500 Index Fund, compared to the black line, which is the pie chart, which is very smooth compared to something as volatile as stocks. So the next system, we're just touching on the 25% trailing loss system. This is a system that we would use if for some reason you really had to buy one stock instead of holding a mutual fund or an ETF. So the rules for the 1% trailing risk stop is that you really don't want to risk more than 1% of your portfolio on any one stock. Remember, stocks have idiosyncratic risk. In addition to all the risks that we see with stock funds in general, you can have stock-specific news for that one stock that you're holding, which could tank that stock overnight. So this is why I tend to stay away from individual stocks. But if you must buy a stock because you absolutely love it for some reason, limit the risk to only 1% of your portfolio. So if you're using a 25% trailing stop loss order, that means you can buy up to 4% of your trading account with that stock. And with the trailing stop loss order, if the stock goes up, then the stop loss automatically ratchets up. And the key is stop losses never go down. When the stocks go below that stop loss order, get out. But if the stock goes up 33%, feel free to buy another block of stock using another 4% of your account. Remember that relationship between 25% and 33%. If the stock goes up by 33%, if it drops 25%, it's back down to break even. That's why we use 33% as our cushion to determine if we're safe enough to buy another block of stock. And just repeat the rules until stopped out. So in summary, as I usually say, there are all different systems I just described. Don't mix up these systems. Keep all these systems separate, with now the exception of Sector Server. Sector Server is built in with both a Storm Guard armor and a sector rotation strategy that can be combined and synergized. But remember, even with Sector Server, there are weaknesses. We review the 20-month moving average system, the monthly rotation investment system, and how to deal with stock tips. And remember, if you have the Dalio All Seasons portfolio, it's the end of the year. Now is the time to rebalance. So keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video from a well-meaning friend or colleague, here are ways to get in touch with me. Seriously, drop me a line, give me a call, set up a consult. A few of you I've talked to, you know your stuff. You're fine. I don't have to worry about you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.